Good morning or afternoon, I guess.
Big class today.
What's that?
Big class today.
Yeah. Hopefully it's not just you and me.
How was your weekend?
It was good. I, I went to a Oscars party. It was the first time I've been around more than like six individuals at once. It was pretty fun. What about
Yeah.
you?
I did a Tough Mudder.
What's that?
So it's a mud run. So it was 11 miles and 24 obstacles. Um, so you're like throwing yourself through mud and over things and
Oh,
whatnot.
that sounds fun.
Yeah, it was.
Cool.
So I'm very sore still.
Well, that's not a bad thing. All right. Hello. All right. Well, we'll go ahead and get started. And I'm sure hopefully a few others will join a little later. Um, but for the sake of time, we'll go ahead and get started. So this chapter, we're starting to look at now the supply side of health insurance. So last week we wrapped up the demand side, which as y'all saw was fairly technical. Fortunately, this chapter is not quite as technical. We don't have to really think about risk aversion here or anything like that. So it's a little more straightforward, fortunately. But right, so last time we saw basically we were using a model of risk aversion as sort of the foundation for the demand for insurance, right? And of course, we saw all kinds of things. We saw that basically consumers overconsume medical care when they have insurance, and it leads to a welfare loss that has to be basically covered by the risk premium that they would pay to avoid the risk, right? Otherwise, otherwise it doesn't make sense to buy insurance, right? And we saw some related issues. Probably most interestingly, the alternative model of risk that we looked at, which was prospect theory. So make sure you take a look at that, Blythe, since you weren't here last time. But today we're looking at the supply of insurance as well as the more recent development within insurance, managed care. All right, so in this chapter, we really want to focus on how managed care can sort of help resolve a lot of the issues that traditional insurance creates. Um, and we've seen this before, right? We saw a lot of this in chapter 4, actually, when we looked at the demand for healthcare, and we looked at how insurance plays into that. And of course, like I just said a second ago, when people have insurance, they essentially overconsume medical care. And on top of that, there's really no incentives in place to control costs. So managed care tries to uh, resolve those issues related to traditional insurance. Um, there's also a lot of different types of insurance these days. So being able to understand all the different types and the varieties or flavors is important. And then with regard to managed care, what are the sort of mechanisms or ways that it resolves those issues? How does it help control use as well as costs? And which of those mechanisms work well and which don't work so well? And lastly, looking at the sort of pervasiveness of managed care and how it is sort of taken over the health insurance market. It is now the predominant form of insurance. And also, uh, well, understanding why that has happened, first of all, but then also looking at the long run sort of consequences of this new type of insurance managed care. So here we're looking at really two major aspects of insurance that we didn't cover in the demand side, namely the supply of insurance and the evolution of managed care, right? Again, to deal with these sort of fundamental dilemmas created by insurance, right? Increased demand for medical care as well as costs of medical care. So we'll start with sort of basic supply of insurance, right? So to think about the supply of insurance, we need to think about the two roles that an insurance company plays. One is pretty obvious to the consumer, and one is probably less obvious. The first one is that the one that's more obvious is that they process medical expense claims and issue checks or payments for expenses that are covered, right? Appropriate expenses, right? So that's the more obvious one. That's what people deal with in day-to-day life with insurance and health insurance. So that's pretty obvious to the consumer. But what's less obvious, but perhaps probably more important, the more important role is that the insurance company is taking on risk, right? It's taking on risk that consumers don't want to have. So that's really the more important role, although it may not be as obvious to consumers, right? Now, it's important for us to keep in mind that insurance companies are in no way altering the risk. They're not able to reduce the risk per se, although there might be some chance of that with managed care, and we can talk about that in a minute. But what they do is they take on those risks and they pool the risks, thereby reducing the average risk that they face, right? So anytime you pool risks, the average risk goes down, right? And so that's really what they're doing. That's also what they're banking on, right? That's how they are profitable. If they were not able to cover lots and lots of individuals in a risk pool, then it would be much harder for the insurance company to actually make money. So that's actually a huge part of how they're even able to be profitable to begin with, right? Now we could actually calculate the average risk, and assuming that risks are completely independent, meaning that the health risks that I face are in no way correlated with the health risks that you face, right? They're completely independent. Then the average risk that any one person faces or is up against is 1/n times the variance that each individual faces. So that's a pretty straightforward way. It's just a simple average, really. But again, that's only true if there's no correlation between health risks. So there may be correlation in some instances and not in others. But as long as they're not correlated, this is a really easy way for the pooling of risk to reduce average risk. Now, if they are correlated, if risks are correlated between people or across people, then the risk reduction is less. So a good example would be an earthquake in Southern California, right? So if Southern Californians were all in an insurance pool and they were covered for earthquake costs, earthquake risks, obviously that's not much of a diversification of risks, right? So in a lot of ways, you can think of it like diversified portfolios when making investments, right? In this case, right, the insurance company would be kind of putting all of its eggs in one basket, and the earthquake breaks the whole basket, right? So it's not really a good diversification of risks, and so it doesn't really effectively lower the average risk in that case where risks are so highly correlated. But what about within the health realm? Like, what's a good health example? Well, there might be correlation in terms of contagious disease, and this is really true with regard to the pandemic. But also things like the flu and just common colds. There's some correlation there. But overall, the correlation is actually really small in most of these cases. And so the insurance company is still able to effectively spread its risk over a lot of people and reduce the average risk. Um, and so like with most cases, when we're analyzing the supply side, we think about production and production functions, right? That's usually where we start. And so for the insurance company, it's pretty straightforward. It's a pretty simple production function, right? There's really only two costs that the insurance company incurs. That's the sort of administrative costs involved with processing insurance claims and customer support and those sorts of things. So the administrative costs, and then the other main cost is obviously paying out money to patients for their medical claims, right? So their cost structure is pretty simple. And ultimately, what they are supplying are claims payments, right? That's kind of their product, and we can use that as sort of an observable product on which we can build a production function. And so, if you think about the types of inputs, right? All of these tasks, or at least most of them, primarily involve people and computers. That's really it. And then, of course, a building to house the people. But of course, now we've seen in the days of COVID that people can easily work from home in these types of situations. So maybe buildings won't even be necessary uh, as we move out of the pandemic, right? Um, but anyway, those are kind of the main inputs: are people, technology or computers, and buildings to house them. And so the inputs are pretty straightforward. Now, because the insurance company can expect to pay out like an average benefit, really the only way to pay for these other costs, these administrative costs, are with the loading fee that we've discussed previously in the last chapter, right? So that's really the source of revenue, is the loading fee, because the money that they take in premiums are pretty much going to be paid back out in terms of expected benefits, right? So in a way, we can think of the loading fee as the company's revenue. And I think you'll see what I mean in more detail in a second here. And in particular, right, the loading fees can go up or down, kind of in correspondence with the costs of the company as well as the structure. So anything that the insurance company does to lower its costs will help to lower the loading fee, and vice versa. And the structure has obviously an impact on those costs. So, you can think, if the insurance plan is complicated, then it might take a lot of human resources in order to justify a claim and make a payment. And in those cases, the loading fee would be higher, as opposed to a plan that's more straightforward and simple, in which the claims might actually be easily processed by computers, in which case you don't need a lot of human resources. And of course, computers are cheaper than humans. And so the loading fee would be lower in that kind of case. So um, the number and complexity of cases can also affect the loading fee as well. So obviously, if there's more numerous cases, that takes a more significant workload, and similarly for the complexity of claims as well. So again, pretty straightforward, right? Now, there is another relevant cost, and it's actually a negative cost. And this is in terms of the premiums that are paid, right? So if you think about it, insurance companies collect premiums at the beginning of an insurance period. So that might be 3 months or a year. And then they basically take that money and they hold on to it. And over the course of that time period, they might slowly pay out benefits. But in the meantime, they can hold on to those, and essentially you could think of it like putting money in a savings account, right? They basically put these funds in some sort of savings account, or maybe a certificate of deposit, or maybe they even buy government bonds with it or something. But they basically take that money and hold it in some sort of investment that makes a rate of return. And so in that sense, there's a negative cost because they're actually getting paid, right? So in the interim, they get to hold on to that money, which they can use to make investments and make a return on. And so this also will have an impact on the loading fee, right? If the company is able to make a higher rate of return, then that negative cost is bigger, and which means that their total overall costs will be lower, so they can lower the loading fee. So just to give you an idea of some of the rate of return on these on holding capital over the last couple decades, it's kind of fluctuated between 0 and 10%, and on average, it's been somewhere around 5%. So to kind of put this into a numerical example, if the company is able to hold on to those funds for about half of the year, then the insurance company can earn about 2 to 3% of premiums as investment income, right? And so this kind of provides some benefits or some extra funding to the insurance companies, but it's really not going to be enough to cover all of the administrative costs, in which basically means that loading fees have to be positive, right? If it were able to cover all the administrative costs, then there actually may not be any loading fee, but the administrative costs typically exceed that which they can earn as a return on this investment. Okay, so these are all the kinds of things that are being incorporated into the production function, right? Pretty straightforward inputs: people, computers, maybe buildings, although that's becoming less of a necessity, and then the fact that they can earn a rate of return on the premiums that they hold, before they end up making payouts to claimants. All right, so like I mentioned at the top, there's lots of different varieties of insurance companies, as the industry has evolved over the last 60 or 70 years, right? So initially, most insurance companies offered a very straightforward coverage. In most cases, it was full coverage, so they fully covered medical expenses. But then as time went on, insurance companies became smarter. There was also another change, and that's the fact that in the beginning, most insurance companies were not for profits. But over time, most of them have actually converted or been formed as for-profit companies. And so that also has had an impact. So today, most insurance companies are for-profit. The most well-known, that should be NFP, not for profit, not NFT. The most well-known is Blue Cross Blue Shield. So I'm sure you've heard of that, sometimes referred to as the Blues. So that's the most common, well-known, not-for-profit. And it's interesting that most today are for-profit companies because there are several advantages that not-for-profit formation has over the for-profit formation of insurance companies. So talk about those real quick. So the first and most obvious is that they are exempt from taxation. So in many states, there is a premium tax which is charged on all types of insurance. That includes auto insurance, business insurance, home insurance, but not-for-profits are exempt from this. And so they basically, that allows them to have a price advantage over their for-profit competitors. They're able to basically produce at a lower cost, and that allows them to offer a lower price to their customers. And in addition to this sort of premium tax, they're also exempt from other types of taxes like federal and state corporate income taxes, property taxes, etc. So those are, that's the tax advantage. In addition to the tax advantage, they also don't face as many regulations as for-profit companies. So, and these are typically financial type regulations, regulations on where the insurance company can invest its paid premiums and earn that rate of return on capital. And it also includes regulations on sort of the minimum cash reserves. So for-profit businesses, for-profit insurance companies have to have sort of a minimum amount of cash reserves, kind of like a bank, I guess, with the the fractional reserve banking system, kind of like that, I guess, but not, obviously they're not loaning out money, but they are, for-profits are required to hold some minimum amount of reserves, which essentially means that they are um, losing the rate of return on that capital, right? So there's an opportunity cost for the for-profits because they have to hold these cash reserves that they could otherwise put into some type of investment and earn a rate of return on them. Not-for-profits do not have to abide by this regulation, or at least it's not as severe. So there's definitely some advantages to the not-for-profit formation. So it's kind of interesting that most companies today are actually for profit, given the fact that there are all these tax advantages. So there must be some reason why, right? So just to give you an idea about the current market, um, most of the market is now dominated by for-profit insurance companies. The largest of which is United Health Group. So maybe you've had United Health as an insurance provider. So these are figures from 2010. So of course these are a little dated, but in 2010 they earned 87 billion in revenue and made almost $4 billion in profit. The second largest was WellPoint. They had 65 billion in revenue and almost 5 billion in profit. And then the other of the top 5 insurers were Aetna, Humana, and Cigna, and they also each earned substantial amounts of revenue and profit as well. So you can see that, you know, just looking at the top 5 is a pretty big market, right? Billions and billions of dollars. Now, when you look at the profit and compare it to the revenue, it might seem like the profit margins are relatively small. You know, you look at United Health Group, it looks like it's about 5% profit margin, which, you know, is not terrible, but it's also, you know, it seems like it's not necessarily that big. But we really have to be careful about the way that we think about profit margins with insurance companies, because you have to keep in mind that a huge part of their revenue that they're bringing in is going to be paid out in terms of benefits. So maybe looking at total revenue and comparing that to profit, maybe that's not the best way to really think about it. Probably a better way to think about it is to think about post-claim revenue. So after, you know, basically, which is the total revenue minus all the claims that they pay. And so if you look at it that way, about 50% of their post-claim revenue is profit. So that's pretty huge if you think about it in those terms, right? That's a huge profit margin. And so up until like the late 80s, the not-for-profit model was kind of the norm, definitely dominated the market up until the late 1980s. But then after the 80s, there was a pretty dramatic conversion from not-for-profit to for-profit. And it really came from sort of 3 areas. The first was the Blues. So the Blues had maintained regional monopolies. And because of that, they were essentially limited in capturing effective economies of scale. So they weren't able to really benefit from expanding the way that a for-profit might be able to. Another reason is that the non-for-profits up until the 80s were very, very similar to basically what's considered traditional insurance, where there was full insurance coverage. Although there was still sort of the traditional fee-for-service payment type. And so this also, right, contributed to the change, the transformation. Again, because under the traditional insurance type, especially those with full coverage, that's when the welfare losses are huge, because you have patients paying 0 co-insurance, and so they have absolutely no incentive to limit their their medical care consumption. So you have way overconsumption, which of course costs the company a lot, And then also this fee for service payments type setup, right, where the doctors and physicians and their practices are getting paid per procedure, right, basically. That also incentivizes the doctors to induce demand potentially, right? So, you know, all of the issues we've talked about before were present in the non-for-profits up until the 80s. One other reason for the transformation to for-profit was that as the sort of optimal scale or size of insurance companies increased, and at the same time managed care became more prevalent, the need for capital to create these types of companies essentially became out of reach for not-for-profit companies, right? So, and so again, sort of this limitation on economies of scale. In order to achieve those economies of scale, the insurance companies really needed to expand quite a bit, and so they needed the money to do that. And not-for-profits have trouble generating that sort of capital. So that was another reason for the transformation to for-profits. For-profits can easily generate capital to make those types of investments, to become larger, and also to undertake managed care, which can be a little bit more costly administratively, at least up front, because it requires technological systems, communication systems, all kinds of things in order to monitor and control the types of access and those sorts of things. So, another issue related to this transformation is the emergence and prevalence of group insurance, right? So today, most insurance is not sold to individuals, but rather large groups, primarily through employer-based health insurance. And of course, we've seen sort of the two advantages from group insurance. The first is economies of scale. So of course, as you insure a larger and larger group, the insurance company can enjoy larger and larger economies of scale, and so that brings their average cost down, of course. And the group insurance also creates a way for the insurance company to avoid the issue of adverse selection that we've talked about, where bad risks chase the good risks, right? Unhealthy people trying to pretend like they're healthy people. With group insurance, particularly with employer-based group insurance, it's harder for the bad risks to do that because it means they have to get a job with the company. They can't just sign up for the insurance and pretend like they're healthy, right? There's sort of an extra barrier, I guess, to entry for them. So let's talk about this first issue of economies of scale, right? So of course, this is related to the loading fee. As the insurance company gets bigger, their average cost declines, right? So they get closer to the minimum of the U-shaped average cost curve. And so as their average cost declines, they can charge their customers a lower loading fee. So that's good. And it kind of brings up a question: what fraction of firms of various sizes offer insurance to their employees? In other words, like, what's the evidence on the relationship between economies of scale and loading fees? And so there's some recent data we can look at here on that. I'm not sure what the time frame was here. It didn't say for some reason, but I'm guessing this is probably in the time frame of the 1990s, 2000s, when this change happened. But the percent of workers on employer-based plans increased from just under 40% to almost 70%. So that gives us some idea that the prevalence of these types of plans, these group plans, was increasing, and that's going to contribute to the economies of scale that the company can enjoy, which allows them to lower their loading fee, which should increase the quantity, right, sold, because the price is essentially coming down. Now, it appears that most of this difference that has taken place is from the rate at which employers offer the coverage, not the take-up rates, which is the percentage of the employee base that accepts the coverage, right? So there's kind of two different avenues in which the increase could come from, but it's mostly coming from the fact that there are more and more employers providing group-based insurance rather than simply the number of employers offering insurance. Group insurance stays the same, but within each group, there are more employees, right? That would be take up. So it's not so much take up that's affecting this. It's more that there are just more employers offering group type insurance. So while this development happened over the 1990s and early 2000s, it really hasn't been until the last decade that we've been able to understand this link between group size and loading fee in a nice way. So this was done by Karaka, Mandic, Abraham, and Phelps in 2011. And they linked several data sets together to derive their estimates, and we can take a look at those estimates in table 11.1. So pretty straightforward evidence. We have group size and how that affects the loading fee. And I think the loading fee is in percentage. I'm not sure of what percentage of, probably percentage of total premiums. That's my guess. So you can see for small groups between 1 and 50 people, the loading fee is a substantial fraction of the overall premiums paid. It's almost 50%, which is really, really high. But then you can see that as the group size gets bigger, that loading fee percentage drops dramatically. And the only sort of anomaly or outlier here is the 5,001 to 10,000 person group size, where for whatever reason there seemed to be an increase in the loading fee. But aside from that, it generally decreases, right? So that supports our hypothesis, right? That as the group size gets bigger, the insurance company enjoys economies of scale, which reduces their average cost and allows them to charge a lower loading fee. And again, the reduction in cost is a lot of it's coming from the spread of the risk, right? So the pooling of the risk lowers the average risk. And so a lot of the cost savings is coming from that, but it's also coming from other places on the administrative side, right? There's definitely economies of scale to enjoy, right? You don't necessarily need to proportionally increase the number of people and computers and buildings you have as you increase the number of people that you insure, right? The cost is less than proportional. Right, so aside from that anomaly I mentioned, the decline is pretty consistent. And that's pretty much to be expected, right, given the nature of economies of scale and the pooling of risks. And so to give you sort of a rough idea of the relationship, and we could express this as an elasticity, right? We could express this as an elasticity since they're both in percentage terms, but basically for every 10% increase in group size, there's about almost 3% reduction in loading fees. So yeah, what would that be? Like the elasticity would be roughly negative 0.3. All right, and then there's also this issue of insurance exchanges that were created by the ACA. So if you're not aware of these, you may be, because they're pretty common these days and pretty well known. The ACA, the Affordable Care Act, rather, Obamacare, right, established these sort of regional insurance exchanges. And it was mainly out of concern for the high loading fees facing these small groups, as well as individuals, right? So these insurance exchanges were a way for the government to try to combat these high loading fees that small groups and individuals face. Now, each of these exchanges, typically it's a state by state, although there might be sub-regions within a state. But in any case, all of these exchanges are either governmental run by the state or local governments, or they are not-for-profits. And there's four levels of coverage that the ACA requires within each of these exchanges, kind of, named, familiarly according to these metals, right? So bronze being the lowest and platinum being the highest. But each level corresponds with a minimum amount of coverage. So bronze is the lowest amount of coverage as defined by the ACA, which means that a bronze plan has to have at minimum 60% average coverage. And then it goes kind of up in 10% increments from there, going from silver to gold to platinum. And so all these exchanges have to adhere to these out-of-pocket limits. And so again, it's helping protect these individuals or small groups from high costs. Something else that the exchanges do is they offer income-related coverage that are linked to the maximum out-of-pocket expenditures. And so this is done by using the federal poverty level, or FPL. So people that are really poor, like the poorest individuals, so these are people that are at 100 to 200% of the federal poverty level, meaning that they earn at the federal poverty level, that would be 100% FPL, up to 2 times that amount. And so for those people, the maximum out-of-pocket expenditure is 1/3 of the health savings account defined maximum, which we'll talk about in a minute what a HSA is in more detail. But basically, the out-of-pocket limit is only 1/3 for this group. Now, I will say that for people that are under the federal poverty line, so less than 100% of the FPL, they are covered by Medicaid. Okay, so they're given government provided insurance, so they're not eligible for these exchanges. So this is for people that are like poor, but not like super poor, because if you're super poor, you get Medicaid. For those that are between 200 and 300 of the federal percent of the federal poverty line or level, the limit is 1/2 of the maximum defined out-of-pocket expense. And then for the last group, 300 to 400% of FPL, it's 2/3 of the max is their cap. So again, these insurance exchanges are designed to try to help essentially poor individuals that either have to buy their own insurance or they are part of a small group, so they don't get to enjoy the benefits of these large group employer-based insurance plans. So just to give you an idea of these sort of limitations, the federal poverty level guidelines start at about $11,000 for a single person. And then they increase sort of incrementally for larger families. So almost $15,000 for a family of 2, about $18,500 for a family of 3, and it kind of increments upwards. And then it gets to a point where if the family is 8 people or larger, it's just a cap of about $4,000 per person. Okay, so again, these are caps on out-of-pocket expenses. So as a numerical example, a person, a family of 3 people with income close to $60,000 could qualify for reductions in their out-of-pocket limits. All right, any questions so far? Okay, so we're going to move on to a discussion of this issue of managed care, right? Which again has evolved out of a response to the sort of perverse incentives that traditional insurance creates, right? So again, the excess use of medical care, basically ignoring costs. There's no incentive for patients to shop for better prices, right? All of these problems are attempted to be addressed by managed care. And we really need to understand fully sort of the problems and issues revolving around managed care to really understand the healthcare system fully, because again, this is sort of the most prevalent type of insurance these days. So one of the main differences between traditional care and managed care is that managed care organizations are directly involved and actively involved not only in the delivery of healthcare, but also the provision of insurance. I think I said that backwards. The emphasis should be the other way around, right? They provide insurance, right, like normal insurance companies, but they also actively involve themselves in the delivery of care, which is something that traditional insurance doesn't do. Their traditional insurance is not involved in the provision of care. They just provide insurance. And there's several varieties of managed care. You can look at box 11.1 for more details of the different types. We're going to talk about some of the basic essential features of the different types. But before we get to that, let's think about why managed care, right? Like what's the point, right? Again, it's a response to the problems created by essentially another problem, right? And that's financial risk. So the reason insurance exists at all is because of financial risk and the fact that people are more than likely risk averse, right? That's the initial issue, and that's what creates insurance. But of course, standard traditional insurance, in response to that financial risk, creates other problems. And so managed care is a response to those secondary problems, right? And we've talked about this. We're kind of beating a dead horse at this point, but standard insurance alters consumers' behavior in a way that basically makes them overconsume healthcare, which essentially creates welfare losses, right? So that's what we saw in the last chapter. And we also saw in the last chapter that consumers balance these losses against gains that are provided to them by transferring the risk to the insurance company, right? So they offload that risk, that provides a benefit to them. And so they're weighing that benefit of offloading the risk to somebody else against the welfare losses that they incur as a result of over consuming medical care. And so what managed care tries to do is it tries to improve upon the situation by interfering essentially, or intervening in the decisions about both the amounts of care as well as the types of care that are chosen. Okay, so that's what we're going to cover for the rest of today, are sort of the interventions. And today we'll only really cover the interventions that are associated with consumers. Next time we will continue with interventions that affect providers, and then wrap up the remaining two sections of this chapter. But for today, we're looking at managed care and primarily the ways that they affect the consumers, right? So typically, really all that's involved, you can think about it in the most simple terms as placing a constraint on consumers, right? So that's really what managed care does in one way or another, right? They're limiting consumers' access to medical care. And they basically do this in an attempt to offset the overuse of medical care that happens with traditional insurance. So it incentivizes and constrains in order to try to reduce the quantity of care as well as the cost of care. Another thing that they do is they also try to sort of shift consumers to lower cost alternatives when they are available. Okay, so all of these things are acting to lower the costs, right, of insurance by reducing the expenditure, right? Now, it's important to note that the reason that MCOs are so popular is not simply because they offer lower cost plans, right? there are lots of ways in which normal or typical standard insurance companies can lower costs, but they typically come at a trade-off, right? So um, premiums could be reduced, but that typically comes with lower coverage, right? Which of course means that the consumer itself is shifting between preferences for um, payments, premium payments, and coverage, right? So that can't the lower cost of coverage can't be the only thing driving their popularity. It has to be something else. And really, the real value of MCOs is that they're simultaneously reducing costs of insurance while maintaining a similar level of coverage, right? So that's the real kicker there, is that they're able to maintain similar levels of coverage to those plans that are fee for service type plans. And so this is kind of an interesting situation because um, patients or consumers are essentially self-selectively limiting their options, right, in exchange for lower payments. Um, and it's done so in a way that actually allows them to achieve a higher overall level of expected utility. Otherwise, they wouldn't choose it, right? So there must be a higher level of utility to be obtained through these plans. And so this is kind of an interesting scenario, right? Because in most cases, um, purposefully limiting options, typically you can think about it as a reduction in the budget constraint, which of course would tend to decrease utility. So it's very interesting where there are cases where actually limiting the budget constraint helps achieve a higher level of utility. And so there's actually quite a few common games, right? Game theory, where there's such an outcome where purposefully limiting or pre-committing to a limitation actually helps the agent or the consumer achieve a higher level of utility. So this is actually an interesting result. So what are the sort of market trends that have taken place over the past several decades in terms of traditional care versus managed care? Right. So we've been talking about the fact that there's been this shift towards managed care over the last 2 or 3 decades. And like I mentioned a little bit earlier, up until the late 1980s, conventional insurance kind of dominated the market. But as managed care began to evolve in the late 80s and early 90s, it became clear that the cost advantages were abundant. And so these types of plans soon took over. And we can actually see the evolution of market share between these different types of plans in table 11.2. So let's take a look at that. So all the way to the left, we have conventional plans, right? Which you can see absolutely dominated the market up until 1988, right? 73% of all insurance plans were conventional up until 1988. Still a pretty large share even in 1993, 5 years later, but then you can see that they quickly declined in their prevalence. Now, all of these other four plans, these are all different types of managed care plans. So you may have heard of HMOs and PPOs. POSs were another type of, it's a variant of PPOs that we'll talk about. And they gained in popularity in the 90s, but then sort of dwindled out after the 90s. They're still somewhat prevalent, about 10% market share as late as 2011. And then the other type is these CDHPs, consumer direct health plans, which are relatively new. They came about in the mid 2000s and have been increasing in popularity. So you can see that obviously they didn't exist at all up until 2006 when they were created out of basically legislation. So this is sort of a government created type of plan. And then since their invocation in 2006, they've been growing in popularity. So it'd be nice if we had some figures that are more recent here. We could see how how much these things have changed. But what you can observe here is that HMOs and PPOs were kind of the initial predominant managed care plans. They grew in popularity over the 90s, but then HMOs sort of just started to sort of dwindle after the 90s into the 2000s, whereas PPOs have kind of become the predominant managed care type of plan today. And I think that's still true. I think PPOs are still the most common types of managed care plans. So let's talk about each of these different types. So just some things to observe. HMOs, again, were pretty popular in the 90s, but then in the 2000s started to decline. And then following HMOs, these other three types of models gained more market traction. So PPOs, definitely the most popular. And then this other plan, the POS plans, which again are a variation on PPOs, started to be popular, but then they lost their popularity as their share declined to 10%. We'll talk about why they lost popularity. And then the last one, these consumer direct health plans have been increasingly popular and were as much as 17% of the market share in 2011. And then, of course, we saw conventional plans are basically almost non-existent at this point. So what seems to be obvious from this data is that people want to control costs as long as there's minimal effect on their treatment choices. Okay, so again, HMOs are able to reduce costs by somehow constraining the choices of patients. But patients, of course, are going to be resistant to these limitations. So they want plans that are able to control costs while minimally affecting their choices. So HMOs, they were the first really type of managed care plans, and they actively control costs, and they grew very quickly while there were no other MCOs. But then PPOs came along and started to sort of steal away the market share from HMOs. And the primary reason that PPOs were able to steal this market share is because they interfere less. So they limit patients less than HMOs do. And that's what's allowed them to steal market share. These POSs, very much like PPOs, the main difference is that they allow out-of-network care. So if you've ever been part of a PPO, you had in-network coverage and out-of-network coverage. And typically the out-of-network coverage comes at a financial penalty. Now this issue of out-of-network care becomes less of an issue the more broad the PPO network is, because the bigger the what's the other word for it other than network? Crap, I can't remember the name. Anyway, I think you guys know what I'm talking about, right? There's a group of doctors and providers that's part of the plan, and then there's a group that's not part of the plan. The group that's part of the plan is in network. The part of the group that's outside of the plan is called the out of network group. And so obviously, if the network is bigger, then these out of network doctors become less of an issue. And so basically, when there's widespread PPO participation, lots and lots of providers are part of the network, it makes this POS model much less relevant. And in fact, that's probably what has led to the decline of the POS type model, is that these PPOs have gotten so big that there's no reason for a patient to seek someone out of network, because there's so many doctors that are in network, right? All right, and then with regard to this latest model, the CDHP model, consumer direct health plans, these are plans that come with what's called a health savings account, or HSA. So this is a relatively new innovation, and I think that the reason they're becoming so popular is because It's a really great way to sort of plan for medical expenditures. Okay, so basically, the way that these plans work is that they have a really high deductible, right? So before your insurance even kicks in, you have a huge medical expense that you have to achieve before you start getting insurance payments. And this acts as a control on utilization, right? A pretty strong control, because if you want to go to the doctor, you got to pay for it almost entirely out of pocket until you hit this deductible, right? So that's a pretty strong incentive for individual consumers to not over consume medical care. Now, once this deductible is reached, typically the consumer pays only 20% out of pocket after that. And typically, right, this deductible is so high, it's usually referred to as a catastrophic type plan, because the deductible is so high. So it seems like, okay, you might be thinking, well, why would anyone choose this type of plan with such a high deductible? And the answer is the HSAs, the health savings accounts. And one important aspect of these is that they are tax protected. So any contributions to the HSA is tax deductible. You don't have to pay taxes on that contribution. And so the money goes into these accounts, which that money is then used to cover expenses, which of course go towards the deductible. And then once the deductible is reached, the 20% co-insurance rate kicks in. But basically, any contribution to the HSA covers these expenses, and it's tax-free or tax protected. So that's a really nice way to pay for these, because otherwise, with other insurance plans, you make some money, you have to pay taxes on that money, and then using your disposable income, you buy insurance, right? So you don't have that tax savings benefit as you do with these CDHPs and HSAs. So these are actually very similar plans to the plans that Keeler et al. Found in 1998 as the best mix of deductible, co-insurance, and maximum out-of-pocket expenditures. So we talked about this. I can't remember what chapter it was. I think it was the last chapter, where Keeler et al. Found sort of an optimal mix of insurance. And these plans end up being very similar to that theoretical optimal insurance that Keeler et al. Found. They also happen to match the types of plans that are predicted by the expected utility theory model that we looked at to be the best for consumers to minimize both their risk-bearing losses and the waste from excess expenditure coming from moral hazard type behavior. So that's interesting, right? We have these theoretically predicted optimal plans that the CDHPs match very closely, which is maybe why they're doing so well, right? And then one other thing to note about these plans is that they're not available to people on Medicare, so people over the age of 65, and that includes the Medicare Advantage plan, which is called Medicare Part C. So just a little extra bit to know there about those plans. So it's also helpful for us to think about these problems from the physician side of the market, right? So thinking about managed care from the physician's standpoint, because basically with all these plans, you have a physician group, right? The network group, and physicians voluntarily participate in the group. So they choose to either be part of the group or not part of the group. So we have to think about it from the physician's standpoint, right? And so to think about this, we can look at a survey from the American Medical Association, and they asked some questions about the reliance on managed care patients. And we can look at the results of this summary in table 11.3. But basically overall, just to have like a summary statistic, 88% of doctors had some level of managed care contracts, and they derived over 41% of their income from those managed care patients. Now we have to think about this 41% a little bit more closely. It deserves some special attention. And the reason we have to think about it more carefully is because there's also government provided insurance that is providing revenue to doctors as well. And we might want to kind of ignore that, right? So if we think about that, this fraction actually represents a much higher fraction of the private healthcare market than one might think. Right. So to think about this, we have to understand that there are some states that have managed care Medicaid. So they actually implement their Medicaid plans using managed care. Not all states do this. And additionally, some patients choose that option. So in some cases, there's an option for managed care versus standard Medicare. And most of the managed care that is chosen comes from private patients that are under age 65. So to break that down, government programs pay for about 45% of total healthcare costs, which leaves 55% coming from private payments. So if we compare that 41% to the 55%, then about 3/4 of all physicians' non-governmental revenue is from managed care contracts. So 75% is coming from these managed care contracts. So I should restate that. 75% is coming from private payments that are managed care type plans. So that's a pretty substantial portion. Another way to think about it is that only 1/8 of their income is coming from non-managed private plans. That's another way to think about it. All right, any questions before we move on to types of interventions? Okay. So again, we're going to focus on the consumer side interventions, right? And again, the whole point of managed care organizations is to intervene in order to lower costs. And it has to find ways of limiting or lowering costs that are acceptable to consumers. Otherwise, consumers won't choose their plan. Okay, so they do this by altering incentives as well as changing the rules of the game for both consumers and providers. And we're gonna focus on consumers today. And so we're gonna look at these mechanisms, focusing on the consumer mechanisms that are used. So a lot of the interventions are dealt with directly with consumers and consumer behavior, and they are ultimately aiming to affect consumer choice in a way that reduces their consumption of medical care, as well as incentivizes them to choose lower cost alternatives. So those are the primary ways of altering consumer behavior. So co-payments, that's the first most common and easily understood intervention. And we've talked about this briefly, I think, in chapter 4. So you're probably familiar with co-payments. These are fixed payments for each instance of medical care use. Typically ranges from $10 to $40 for non-specialists. It can be slightly higher for specialists and emergency room visits, maybe $50 or $60 per instance. But this is what we talked about in chapter 4. And the consequences are relatively straightforward, right? If you just pay a flat fee to go visit the doctor, you have no incentive to shop for a better price. So that's an issue, right? But this turns out to not be an issue for managed care plans because they actually do the shopping. Managed care plans shop for better prices and incorporate physicians into the group, the in-network group, that have or are willing to provide lower prices, right? So this really isn't an issue. The MCO already does the shopping. So the fact that the co-payment eliminates the incentive for consumers to shop doesn't really matter. The MCO already does the shopping to begin with. So this isn't really an issue. But it does it does act as an incentive for the consumer to limit their consumption of medical care, at least when compared to the full coverage alternative, right? If the patient has full coverage, in other words, zero copay, then they're going to consume more medical care than a consumer that has some positive level of copay, right? So this is just a method of cost sharing, right? It's similar in ways to co-insurance, but instead of a rate, it's just a flat fee, right? Another intervention that was attempted, although this one kind of failed, was what's called second opinion programs. And so this was a way for insurance providers to get to incentivize a second opinion, particularly with regard to surgery. So this was mostly for surgery, and the idea is that the plan pays for a second opinion from another doctor, but it makes clear to the second doctor in particular that the second doctor will not be the one providing the operation or the surgery. And in this way, it sort of helps to address the issue of induced demand, right? The only thing the second doctor is asked is whether or not they agree with the original recommendation. So that's their only role. So again, this really helps address that particular principal agent problem, induced demand, right? So of course, the first doctor may have an incentive to say, yeah, you need surgery, because they have a financial incentive to provide that surgery. But then of course, the second doctor has no such incentive since they will not be providing the operation. So really the attempt here is to get the first doctor to be honest, because they know that there's going to be a second opinion where there is no possibility of induced demand. And the insurance company only pays for the operation if the second opinion agrees with the first opinion. Okay, so that's really the limiting factor here. And in a way, the insurance company, by doing this, kind of is signaling to the consumer that, hey, there's a possibility of induced demand, right? Which is why we're asking you to get this second opinion. But it also creates a way to get advice that's free of the perverse financial incentives, because the second doctor can't perform the operation. So there's a lot of intuitive appeal to this model. But for whatever reason, and we'll talk about some potential reasons, these types of programs have not done well in altering the choices of the patient. So why might that be? Well, it turns out that it seems that patients might be reluctant to take the second doctor's advice if it's contrary to their original doctor's advice. So, it might be, oh, well, I don't want to go against my doctor. I have a good relationship with them. I trust them, something like that. Or it may be some other reluctance, but in any case, there seems to be a reluctance to want to take alternative advice. Another issue may be that typically the second opinion is from a doctor that is geographically near the original doctor. And so there's a good chance that their medical practice styles might be similar, and so they will offer similar advice. So there's really no difference in opinion here, right? Which of course means that there really won't be any change in consumer behavior. So those are the two most likely reasons that this type of program hasn't performed well. A third intervention on the consumer side is similar to the second opinion model in a way. It's called the gatekeeper model. And you may have been familiar with this. So this is when the insurance company requires the patient to see a primary care provider before seeing a specialist. And they need the referral of the PCP in order to go see the specialist, right? Now, of course, the primary care physician visit costs the insurance company money. So it must be the case that in order for this type of plan to work, the gatekeeper must in some way reduce the incidence of treatment from the specialist. Otherwise, the extra cost of the primary care physician visit wouldn't be justified. And this belief is actually backed by a couple of sources. The first is that the primary care physician's costs are typically lower than the specialists. And in addition to that, they receive a lower fee for any procedures conducted. And because of this, the insurance company can actually rely on normal economic incentives that sort of motivate the generalist or the primary care physician to try to hold on to the patient rather than referring them to somebody else, right? They want to capture that patient and their revenue rather than sending them off to a specialist unless the specialist is like really, really needed, right? And so what the model is doing is it's preventing the patient from just going straight to the specialist, which of course is more expensive and incurs higher fees. Now, unfortunately, the data supporting this presumption is actually relatively sparse. One of the first studies of the gatekeeper model took place in Seattle, Washington, and it provided a case study of basically a failure of this model. And what they found was that it offered incentives to providers that unfortunately did not support this model. And because of the limited efficacy and effectiveness, as well as unpopularity with doctors and patients, most managed care organizations have abandoned the gatekeeper model. So this was actually very common in the mid 2000s to early 2010s, I guess, but it's pretty much gone away at this point. All right, so really the most prevalent and still common form of patient-side intervention is the co-payment model. These other two models have really not done well and so have kind of started to disappear. So that's it for today. Next time we will look at the interventions on the provider side of the market. And then we will look at which interventions work best for managed care. We already have an idea of the interventions on the consumer side. It seems that co-payments are really sort of the best, most effective interventions. Those other two types didn't do so well. We'll take a look at which type of provider interventions do well and which ones don't. And then we'll wrap up the chapter by looking at some long run issues related to these interventions. So we should be able to wrap this all up on Wednesday. And then next week, we will take a look at Medicare and Medicaid, government provided insurance. And maybe we might have a little bit of time for a brief discussion on the international comparisons that I want to cover, but I don't think we'll really have much time to look at that. I'll probably just leave you with the nutshell overview of that chapter, but at the very least, we should be able to cover Medicaid and Medicare next week. So that's what we're looking at. We'll wrap this up on Wednesday and then cover Medicare and Medicaid next week, and that will be pretty much the conclusion of our semester. So Bella, I know you asked about the recordings. I started getting those posted, so I think I have chapters 1 and 2 posted right now. I'll get the remaining chapters posted later today. Hopefully all of them. I should be able to get all of them posted later today. So you'll have those to start studying for the final. I think there was one day that for whatever reason, I think I must have forgotten to record or something. So there is one lecture that we don't have a recording of. But you can always reach out to me if you have any particular issues with that material, or your classmates as well. But yeah, that's kind of where we sit, and we're out of time for today. So do y'all have any questions before we go? Okay. All right, cool. Well, y'all have a good day, and I will see you on Wednesday.
Thank you.
Yep. Bye.